Welcome to our second lesson in our Forex Trading Masterclass. This is Propfirm Trades, teaching you how to trade. So in our second lesson, we want to learn about a variety of things. First of all, we want to learn about candlesticks. Candlesticks exist in two forms or two types. There are two types of candlesticks, the bearish candlestick and the bullish candlestick. These are the candlesticks that will determine your entry into the market. They will also determine the market structure, as I will show you as we go along the lesson. So a bearish candlestick is determined by a bearish trend. Bearish candlesticks are the red candlesticks that you see on your chart. At times they might not come in red. The color is personal. You can put whatever color you want, but these are the candlesticks that you see with a downward movement of price. So a bearish candlestick opens at the top and closes at the bottom. This is what will signify a bearish candlestick, and it makes the price to go down. So a bullish candlestick is exactly the opposite of the bearish candlestick. It's denoted by a blue color. The color is personal. Remember, you choose whatever color you want to denote your bullish candlestick. So it opens at the bottom and closes at the top. So you will see in these candlesticks that you can have those lines that just come on top of or below the candlestick. These are called wicks. These are shadows. We'll talk about them, or maybe let me just talk about them now. This will signify that, let's say, it's on a bearish candlestick. Price opens at a certain place and then it continues to go down. But for whatever reason, the bulls push the price back up to the opening price. That means that they will leave a wick, there will be seemingly a blank space. A wick, a line will be left, and then you'll have the body of the candlestick. As the price is pushed upwards, it will become blue. If it's maybe a wick on, it will become blue, and then if the price continues to go up and the bears come into play and push the price down, it will, they will leave a wick. That shadow is the wick, that line is the wick. So this just means that there's a movement that's opposing from the current candlestick. So these are your bullish and your bearish candlestick. They determine your market structure, which is what I want to talk about now. The market structure is the layout of the market. What you see on your chart, if you open your chart, the first glance that you have, you're seeing the structure of the market. So a structure of the market falls under four different types. Structure of a market can be trending, can be ranging, or it can be noisy. So did I say four? I guess it's three. So a trending market can be bearish, where the price keeps going down in an overall direction, or it can be bullish in a bearish trending market. This is where it will be denoted by higher lows and lower highs consecutively as it goes down. So the market can be trending up, trending down, which is the bearish trend, or the market can be bullish, which is the uptrend, where you see consecutive higher highs and higher lows. So the market will be moving, as you can see in that picture, going upwards. This will determine that your market is trending. This will determine the structure of the market, and it will show you that we are looking at a trending market. So the trend can be bearish or bullish. So the second market structure we want to look at is a ranging market. This is a sideways market where price seems to be moving from one side to the other side, from the left to the right. Price continually bounces between two ranges. It bounces more of between the top part and the bottom part. So it bounces between a support and a resistance, as shown in that picture. Price will eventually break out from that bounce, from that confinement, when it decides which direction it wants to take. So you can actually trade that range, but you have to be careful. We'll talk at how we trade later on. I'm just defining the market structure. So the last type of market that I want to look at is the choppy market. This is also known as a noisy market. So a noisy market, there's no seeming direction. It's directionless. There's noise all over the place. You can't see where the price is coming or going. this type of market we do not trade. We close our charts and look at another instrument or go to something else. So this is it about candlesticks and the market structure. We'll look at our next lesson, which will be on chart patterns. So thank you for listening. And what I want you to do now, go to your chart, look at candlesticks, and also look at the market, look at the structure. Try and see if you can spot a bearish market, a bullish market, which is a trending market. Try and see if you can spot the ranging sideways market. Try and see if you can spot the noisy market. Because you'll have to be able to train your eyes to look at the market and determine the structure before you even start trading, because this is what will help you become a profitable trader. So till next lesson, be doing your homework.